So we were having that, and then in year 2, from the question that we were having, year 2, we were having that is year 1. Then year 2, we also have something. So year 2, we are having 2 options. I think 2 or 3. There were 3. Right. Refer to what you drew yesterday. So what are we having there? They are not even 3.
No, there are 2 only.
There are 2. There are 2. So here you have 7 with the probability of
0.6. 0.6.
And then here we have
6m with probability of 0.4.
And then this other one?
7m 0.5. 6m 0.5. Then 8m 0.3. 7m 0.7.
7m 0.7. So we have been told that in the first example that we did, not example, but the first question that we solved, they were saying that this company was able to operate until the end of 2 years. So what does that mean? It was not abandoned, and we were able to see the NPV, the expected NPV after the end of the period. Now we are told that if we abandon this, the cash flow in year 2, we abandon this. So meaning that after year 1, we are not going to get year 2 cash flow. We are going to sell the machine. It means that in both scenarios, year 1 revenues are already pocketed. We have the year 1 revenue. So we are only comparing. Should we sell it now at 8 million or proceed and get the revenue for year 2? So when you're looking at the abandonment, you need now to compare the cost of abandonment by looking at the sellable value, that is the amount that you're going to get when you sell at abandonment, that is 8 million, and the revenue. What I mean, you need to compare whether it is better to sell it and pocket the money or wait and get the revenue. Then that situation, you'll be able now to advise on whether to sell or not. So we don't work with year 1 revenues. We work for year 2 revenues. You compare year 2 only, and then you compare with the cash that you can receive. Are we together there? If you buy a car, year 1, umepata pesa. Now year 2, you're wondering whether to sell it or not. What you will normally do, you'll compare it. If I don't sell it, how much can I get in year 2? If I sell it, how much am I going to get now? So you compare the revenue in year 2 and the cash that you're getting in cash when you sell it. So you compare those two. Sasa, because in both scenarios, year 1 revenue is not a determinant. Year 1 revenue is already pocketed. That one you have already. So there is no problem there. The problem is whether to now get year 2 revenue or sell it now and get your cash from the sales. So abandonment value, that is the amount that you're going to sell it at. So that is what we're going to solve. Now, when you're doing that, you need now to compare the cash flow here. Now, assuming that we abandon it, what is the abandonment value? We need now to calculate the present value of abandonment. Then we compare with the cash flow that we are going to get in year 2. Present value of abandonment. What is the present value of abandonment? You are going to abandon it after year 2. So you're going to have PV, because it's just once, it's not annual, it's a one-off. So you need to have 8 million that you're going to be paid times PV at the end of year 1, right? So that is year 1, or 1 year, sorry, 1 year at what percentage? 13% there. That is what we're given. Is it true? We were told that the cost of capital is 13%. So we're going to discount that abandonment value and we compare it with the cash flow for year 2. So we need to discount it, and then we shall also discount year 2 cash flow. What was the figure that you're having here? Hapa tulipata ngapi? 0.6. 8. Discounting factor in year 1.
For the first year, it was 0.8850.
It is the same. It is the same for first year. So 0.8850. And then
Yeah, 50. Year 2, we got 0.7831.
0.7831. So we will use that one here. This is for year 1 because we are going to abandon it at the end of year 1. So we need to discount this at the year 1. So we have 8 million times 0.8850 because that is the time you shall receive that cash. What is the figure that you're getting? If you decide to go with
7.08. 7.08
million. So if we decide to sell the machine, we shall be getting 7.08 million and we are done. We have an option of not abandoning. So this one is abandonment. When we abandon it, we're going to be given the money and the equivalent, the present value will be 7.08 million. If we decide to go full operation the second year, what will happen? We're going to have the amounts here, right? So we need to get the amount that we're going to get in year 1. What is the amount here? Expected amount, or expected value, expected cash flow. Year 1 is 0.7 times 0.6. No, 7 million times 0.6. That is this one plus this. Ndio tupate ile piga tutaweka hapa. Unakumbuka? So we have 7 times 0.6 plus 6 times 0.4. That is the amount that we're supposed to have here. What is it? What are you getting?
That is the cash flow, Malim, or it is what?
These are cash flow, but the possibility of getting this cash flow is 0.7. The possibility, meaning 0.6. The possibility of getting this one is also 0.6. We are not discounting yet. We are not discounting.
Oh.
We are the expected cash flow. These are cash flow, this cash flow. So this one we can get, this one also we can get here. Before we discount.
Okay, 4.5.
We're getting
5.
4.5 million. So we get 4.5 million here. And then the same here, we're going to have 0.4 or 7. We have 7 times 0.5 plus 6 times 0.5. What are you getting for this one?
Same 6.5.
Same way we have here 8 times 0.3 plus this one 7 times 0.7. We have, so this one is 6.5.
Yeah. Yeah, someone else is lost. Raquel is lost. Maybe
Right.
I'm just writing him, but I'm not understanding anything.
It's okay. So Rachel, hapa uko sawa?
Na
Hapa kuna shida?
no, si understand mbona tuna discount, why we discount?
So I'm not getting what you're saying, but I'll repeat what I'm trying to explain. Now, what happens that in abandonment, it means that you have the machine. You have generated the first year's income. These are the cash flow. Uko nayo. Now, in the second year's cash flow, you are wondering whether to proceed and run the business for another 1 year, or you can stop it. To abandon, basically, wachana nayo, wachana na biashara. Kama hii ya shule, I can say that, okay, we are now not able to operate, so we abandon it. If we abandon it, shule bado iko. Are you going to sell it to somebody? Yes. That person that we are selling it to will give us some money. That is the cost of abandonment. Atatulipa some money. But that is after the first year imeisha, we are supposed to start the second year. So we are talking from the time of investment. Hatujaanza to run. We are at the beginning of January of the first year. We have 2 years. This is the first year, then this one is second year. So this one is year 1. year one, year two, right? This one is year two. So we are saying that this school can run for 2 years. If we are still here, we are standing here. We are saying that we have an option of running the first year, we get our revenue, which are these ones, and then proceed the second year and get another revenue. That is the first option. So we can proceed until the end of second year. Also, we can proceed at the end of first year to tunachana nayo, we abandon it. That is what we are now saying, abandonment. When we abandon it, we are going to forego some revenue here. These are revenues for second year that we're going to forego. And that is what we are having here. Now, on this revenue as second year, when we abandon it here, the benefit that we're going to get, is now year one revenue, year one plus the value of abandonment. The cost we are going to sell it at, value of abandonment. That is one. Alternatively, we can proceed from year one cash flow plus year two cash flow. So year one cash flow plus year two cash flow. So it means that we are not abandoning in this option number two. So when they tell you that the management were undecided on whether to abandon or not, there are two options. They can abandon after year one, or they proceed without abandoning, without leaving the business. If they leave the business, they can sell. Unauza hiyo biashara, mtu mwingine anachukua na una compare ile pesa unauza. Now you can see that when we are now comparing to make decision, we are not going to use the cash flow for year one. This one cancel each other. So you only compare this one and this. Because this cancel each other, they are the same in both cases. So we are only comparing the value of abandonment. Is it better than if we go for another cash flow for year two? Should we operate again year two, or we sell it now? We shall get the value, the present value of both and compare, because this one is already pocketed. So we look at the present value of this and this, which one is higher? That is now when we're talking about abandonment. Now, in abandonment, you compare the foregone cash flow and the value of abandonment. I'm repeating. When you are analyzing and you need to make a decision on abandonment, compare the foregone cash flow, ile pesa utaacha, the one that will leave, the one that will not get. Compare it with the value of selling this business. If you're going to forego a lot of money, ile pesa ungepata ingekuwa mingi compared to what you're getting now, it is better you proceed in operation. But if you compare and find that the net present value of abandonment, that is the cost of selling the business, is higher than if you proceed in operation, the net value of second year's cash flow, it is better you leave because you're going to lose. So that is what we are talking about here. So what we did first, we have gotten the value of abandonment, which is this one. So we need now to calculate the cash flow, the present value of cash flow for year two only. For year two only. So that we can be able to compare cash flow for year two and the abandonment value. Abandonment value was 8 million that will be paid after 1 year. After 1 year, from here up to now, up to that, this time you'll be paid 8 million. You need to bring it to its equivalent value. Today, the present value. That's why I said the present value of abandonment. It is 8 million that will be paid after 1 year. You discount it with PV because it's only 1 year, 30%. You'll get this, and then that is 7 million. So we want to ask ourselves, if we sell it now, after 1 year, we shall get an equivalent of 7 million. What is the present value if we proceed with the operation for the whole 2 year period? Are we now together? Now, because there is probability in the second year's cash flow, we have to use that probability. What I say, that when you're using now probability, you can have the cash flow for year one times its probability plus, and then the cash flow for the first route, this one, times the probability plus this times the probability, unaweka hapa. That is the first example that we did. That is the first example that we did. Unakumbuka? When we were looking at the example, we say, when you want to know the cash flow here, which is now the average or expected cash flow for coming up to here, it depends on this probability. So it is this times the probability times this times the probability up. If it was only year one, Kama tungekuwa na year 2 hapa, tulikuwa tu hapa peke yake. For example, here you only have this times this plus this times this plus this times this. Then you get the figure here. You discount that cash flow because that is the average cash flow. Vile tumepata hii. This times this plus this times this plus this times this. Utapata expected net cash flow. You discount that cash flow and then you now call it expected NPV or expected present value. Because right now it is just expected cash flow. It is not present value. When we discount it, it now becomes present value. We have not discounted it. It is just a normal cash flow. So when you multiply this times this, plus this times this, these are normal cash flow times their probabilities, they become expected cash flow. You could have written it here, even if it is 50.5.2 or 50 million. This 50 million is just a normal cash flow, but has not been discounted. Now, for us to make it present, you now multiply with this. So we have the expected cash flow times the discounting factor to make it expected present value of cash flows. So that's what we are doing. We want to get the probabilities that can make us have this amount. We now multiply this times its probability plus this times its probability tukapata hivyo for each option. For each option. These are just expected cash flow, the normal expected cash flow. We have not discounted yet. Why? Because we are still working on probability. Now, after getting this, we also get this, which you told me is 6.5 million. This one is how much?
7.3.
Are we now together, everyone? Rachel, are we now together? Yes, thank you. Now 7.3. These have not been discounted. We have not discounted, so they are not present value. They are just expected cash flow. Now, these figures, we didn't just get it. There is a probability of you getting this. So here, we have probability of 0.2 of you getting this. Probability of 0.4 of you getting this. Probability of 0.2 of you getting this. So again, we need to multiply them with their respective probabilities. So the first one, what will they figure? What will they figure? For the first one.
0.9.
Because sure this one is 4.5. Can someone confirm all these figures? This one is 7.3. 7.3.
That one is 7 times 0.6.
This one is already 4.2. Wewe unaniambia 4.5. Kuna shida hapa. Hii ni 4.2. Hii ni 2.4. Uki-add.
It's 6.6.
So 6.6.
That cash flow, it is 7M times 0.6, then 6 times 0.4.
Yes. Those are millions.
Oh, 6.6, sorry.
So it was 6.6. Then this one is
Then the 6.5 is correct.
confirm this. This one is giving us 2.4. This one is giving us 4.9. So this is 7.3. That is okay. Okay. Now, we are saying that even though we arrived at year 2, it was not easy. There was a possibility of us arriving there. The probability of you getting this is 0.2. There is 0.2 probability that is on this line. Just the way we had this one, there was a probability. So this one has been affected by this probability. So we need to get again, multiply them with their respective probability. So we have that for us to get 66, there is this probability. So this is 0.2 times 6.6 plus this one 0.4 times 6.5 plus 7.3. So we have 0.2 that we can get 7.3. So this final figure that you're seeing here, it depends on this probability and this. This one that you're seeing here depends on this probability and this. It is not just coming like that. So you need to multiply all of them coming back. Alternatively, to get multiply this times this times this. Then this times this times this. but that will be long way. What we are doing is the easiest. Bring them back. So what are we going to get here? The total here. What are we getting here? For investment, for us to invest, what are we getting here? What are you getting for this three? Tukirudi year 2 peke yake, year 1 achana nayo. Tukirudi year 2 peke yake, this one. What are we getting there?
6.84.
So that is the total expected. Or we just call it still expected cash flow. Expected cash flow is giving you
6.84.
Can somebody confirm that is true? Before even we discount it, those are just expected cash flow, which we had.
Yeah.
They depend on these two probabilities for each, and that is what is coming. Can somebody confirm that it's true?
I'm getting 5.38.
Don't discount past. Don't discount past. Just get me. Hii nikikalculate na hii mimi naona hiyo inakupea 13.2.
The first one gave you 13.2.
Is it 13? It is 1.32. Clear?
1.32, yeah.
This one is giving you, that is 0. This one 24. So that's 2.60. Huh? This one
That is 2.6.
This one is 6, 14. So that is 1.4. Is it?
The last one is 0.4 times 7.3.
Yeah, 0.2. Is this
It is 0.4.
Should be 4.
0.4. Yeah, from the paper it was 0.4.
Good. So 0.4 times this.
But the others has to confirm, is it 0.4 or 0.2? Because maybe I have written it as 0.4 and it is 0.4 according to the paper also.
So
0.2, 0.4, 0.4.
Fine. It is 0.4. So this is 0.4. So just calculate with 0.4 times this. That is 28 plus 1. So we have 2.92. So we have 4. We have 8.6. So the figure is that. Oh, so I think there was a mistake on this percentage. That is why we're getting it differently. Otherwise, when you put
Yeah, because 0.2. You wrote 0.2 there.
Thank you. So now that is the amount. We can now discount this. So what we are saying, if the cash flow is in year 2, multiply that cash flow with all these probabilities. The first thing is to work on this, then the answer that you get, multiply the probability. This is now the expected cash flow for year 2. For year 1 is easy, multiply this only because it is only having one probability, then you add all of them, the 3 of them. But for year 2, you need to work backward like that. That is the expected cash flow in year 2. Separate individually. Now, get discounting factor of this. So we are saying present value of foregone cash flow. That is option number 2. We calculate the present value of foregone. What is the spelling? Cash flow. It is now the expected cash flow for year 2. Which is 68.4 million times now the discounting factor, which is now year 4. It is for year 2 now. So use this one for year 2. 2 years, 13%. So that is 6.84 million times 0.7831.
31.
What are you getting?
5.3564.
5.3564. million. So compare the two. This is now the present value, this is the present value. Which one will you go for?
Abandonment after 1 year.
You can abandon it after 1 year because that's abandonment has got a higher present value compared to you going on with the operation.
But Malim, what I haven't understood is why are we finding expected cash flow 2 of them, but we haven't used the first one and we used the second one? I don't get that. Oh, or the first one we get it through. Oh, so we have to find the second, then go back to the first one. Okay.
That cash
Now I
flow
got it. I have answered myself.
That cash flow for year 2 depends on two probabilities. There is probability, which is 0.2, and then the other probability. So when you look at each line, there are two probabilities. The probability of getting the first one, if you get it, there is another probability. So it has to, you have to consider all those probabilities that made you get the cash flow you're referring to. So that is why we are considering the two probabilities. So we had to calculate and then again calculate again. We have not considered cash flow for year 1 because in both the two cases, the cash flow for year 1 has to be there. Whether you're abandoning or not, year 1 cash flow itself equal. Shida ni year 2 cash flow. We have to compare the year 2 cash flow that you're going to forgo and the abandonment value. Then you compare which one is higher. So that is now the total. So they are saying that what is your conclusion now? You say that abandonment is viable option. Abandonment is viable because the present value of abandonment is more than the present value of foregone cash flow for year 2. So it is viable. It's viable. The second question they are asking, are we together there? The next question they are asking, the last one, number 3. Roman 3, they are saying that determine the expected net present value. Determine the expected net present value. That is the ENPV of the project, assuming it is advantageous to abandon the project. So now we are being asked to get the NPV. In the other two cases, you are being asked just to calculate. In the other one, you are asked to calculate. In Roman 2, you are asked to compare whether to abandon or not. You did calculate the NPV. Hatukutumia IO. We did use the IO. We only used the cash flow, present value for year 1, for the year 2 cash flow. We compared with the cost of abandonment.
So a question. If I haven't calculated anything and I just guess maybe like I guess abandonment is a viable option than not abandoning. Should I get a mark for that or there's
Well, now it depends on the markers. Some markers are good, might give you 1 mark because you can see the question is very well indicating that using a suitable computation. Say that one you need to use a suitable computation. You might have copied your neighbor.
Oh, your neighbor. Oh, okay.
So
I get.
assume that now it is better to abandon in year 1. What will happen? So in year 1, if you abandon, then we need now to get the cash flow for year 1, which we can get expected cash flow for year 1, expected cash flow for year 1. So expected NPV after year 1. That is what you're being told. Assuming that you're going to abandon it, may give us the expected NPV for year one. So you need to get the expected cash flow for year one. What is it? The first one is, we say that for year one, you only take the probabilities. So we are having 0.2 times 7 million plus 0. The other one is 0.4. So times 8 million for year one only plus 0. This is the expected cash flow, just the way we did it for year two. But year two now we did twice because there were two probabilities. So we got the first one and then we multiply the probability in that line. So this one is 0.6 times 0.4 times 6 million times 6 million. So what are you getting as the expected cash flow from the operation? Expected cash flow from the operation. So expected cash flow from operation. From operation from the normal business. How much? Then we have expected cash flow. We are going to sell it. Abandonment. From abandonment. Abandonment is 8 million. That is 8 million. From operation is cash flow from operation is we have two cash flows. The first one is from the normal operation where we are making, we got it, and then the other one. So can somebody give me the normal operation from operation? This times this, guys. That is the money that you're going to get from the normal operation. Alafu unauza machine pia unapata abandonment. Collins. Kwani kuhesabu hii peke yake ni ngumu? Collins. Tony. You guys are letting me down. 7 million. Yeah. Menyamaza. Changamke leo nimeona watu wamenyamaza sana. So the total cash flow is 15 million at year one. This is the total amount that you're going to get after year one. Cash flow from abandonment, cash flow from abandonment. From abandonment is that one, and then from operation is that. So our NPV, we are trying to get NPV. This one is already called expected cash flow. So as long as you are going to use expected cash flow, and how do you get expected cash flow? Probability times amount plus probability times amount, you get expected cash flow. Now that expected cash flow, when you multiply it with the PV, you're going to get expected NPV. So multiply the PV, allow you remove initial output. So our expected NPV is equal to expected cash flow which is this one that we now expect in total times PV, because it is only once year one, so it is year one or 1 year, 13% minus IO. IO, you know it. So here we have 15 million total times PV for year one was 0.8850 minus IO was 10 million. Sio? IO tuliambiwa ni ngapi? Si 10 million. What did they say? They say that XYZ is considering buying a new machine for its manufacturing process at a cost of 10 million. So it is 10 million. So get me expected NPV. Now that we have decided to just get revenue for year one and sell the machine, which give us this. Iko na decimal, hii lazima iwe na decimal. Hebu nipe hiyo figure ya decimal. You cannot tell me that 5 times 5 will be 0. It cannot. Don't round off. Give me the weightage. I know that 5 times 5 cannot be 0. So hiyo figure ya mwisho cannot be decimal. Cannot be
3.275. 3.275.
So you're right. If you want now round it off, sawa, but show it like that, then you can now round it off. So that is the expected NPV of that particular project. So okay. Any question there? Rachel, tuko pamoja?
Mwalimu, Max ni kidogo kwa hiyo kufikiria yote.
Ati?
Max ni kidogo kwa hustle yote, seriously. It is a 2-page question. I have written 2 pages of my exercise book and I'm getting how many marks?
4.
Now that is what happened in the last paper. That is what happened in the last paper. Unapewa marks kidogo, asuli mingi.
Yeah, I know.
It was not balanced. Yeah. Unfortunately.
Better I find September.
I want us to look at an example in 2019. Was it 2019 or 2018? Which one can we do? One of them.
We have 2024, we have 2022. We have a lot of them for decision tree.
Yeah, 2024 hata hizi kuja. Waliset jana hizi leta tena, but we shall do another one that looks like that. I want to give you a very simple one here.
Okay.
Write this one.
Oh, we are writing.
You know, even if you are revising, make sure that you don't revise the most recent questions. Those ones they don't break. Those guys can repeat 2013 exactly the way it is, or 2014 exactly the way it is. Like in year 20, last year they cannot break. In which paper was that? I think it is August last year. In August or December, they brought exactly a question that was there in the previous paper, exactly the way it is. And they were like 2. So when you're revising, the most recent one, don't pay much attention on them. The examiners cannot repeat exactly consecutive sitting.
Okay. But decision tree can come in the exam also.
Sai, very rare because topic number 1 must come and topic number 1 has a lot of things. So they might not repeat this on tree the way it is. There is a possibility. There's a possibility that they can even bring something like they have not brought simulation for a long time. The examiner can test that. I've also seen the last time they brought Nini was 2019. The
simulation.
Sensitivity here breakpoint. I think it was 2019. Because I've seen of late formulator fertility equivalent. Now they brought probability, and then in 2022 August they brought linear programming, which year again? In 2022 December they brought scenario analysis. So we are expecting 2023 or 2024 they might bring simulation. So either way, just prepare yourself. Anything can come. With me, I don't want to predict. Kazi yangu ni kufundisha, uelewe, alafu pambana, sindio? Baadaye kusema, mwalimu wewe ulisema hivi, haijakuwa hivyo, no. I'm repeating decision tree because somebody requested that we need to do a lot of them. So A Limited is considering investing in a project. Requiring an investment of Kenyan shillings 100 million. The project has a useful life. The project has its lifespan of 2 years. The projected cash flow is as follows. The projected cash flow are as below. So we have
That is year one.
year one.
Year one and year two.
Require advice and management using decision tree technique.
So nataka ni
Come again.
advise
The management using
oh
tree technique. This one you can write somewhere, candle, just to help you solve such kind of questions. Don't, it is not part of the solution. Pia ukiandika hapo bado ni sawa. It will help you to revise the tree. So the first rule is draw the decision tree. Number 2, ascertain NPV. Ignoring all possibilities or probabilities. But 3, ascertain joint probability. And the last one, determine expected NPV. Those are the rules that will save your life. When you have situation where you're having you need to get NPV, but you have cash flow for 2 years, the rules here will really help you. So let's start the first one. Where do we start from?
The board is not clear, Matthew.
The board is not clear.
Hatuoni vizuri.
These writings are not clear.
Adjust the camera.
Yeah, I don't know from yesterday. That board is not clear.
Okay.
Umeharibu tena.
Okay. I can read for you. Where do you want me to read? Which figure are you not able to see? A limited is considering, don't read it as unlimited. Is A limited is considering investing in a project requiring an investment of 100 billion Kenyan shillings. The project has its full lifespan of 2 years. The project's cash flow are as below. So we have probability of 0.6, giving you 80 million, 0.4 is 120 million. That is year 1 cash flow. Year 2 cash flow, probability of 0.2, 40 million, probability of 0.8, 55 million. 0.3 probability gives you 35 million, and 0.7 gives you 85 million. 85 million. Required, no additional information, the company's rate of return is given as 12%. Rate of return is 12%. Required, advise the management using decision tree technique. Alafu hint or rules, hint, draw the decision tree. Number 1, ascertain NPV, ignoring all probabilities. First, you can get NPV when you ignore all probabilities. Then ascertain joint probability for each line. So there are 2 options. The one that I've just done, what we did for year 2, we got the expected probabilities. We got the expected cash flow. Then we now did what? Got the NPV. But you can as well use this one. This is the one that we used yesterday. Get NPV for each of them. That is each route. You'll be having different routes. Get NPV for each of them. Then get joint probability for each route, multiply with those NPVs. That is what we did yesterday with the example for 2021. I think it was 2021 question. That is what we did with that. The question number 1 that we solved yesterday. Now, let's look at this. It will still come to the same answer, but it is quite direct. So we draw the probability tree. Where do we start from when drawing? So I can wrap it. Solution, where do we start from when we are drawing?
Whether to invest or not.
Whether to invest or not. They are considering, immediately you are told, considering, start with the alternate node, alternative node. Don't go to NPV, don't go to outcome direct, the state of nature direct. So the first thing is to decide on whether to invest or not. So we start here, and you know the other one is normally taking a smaller space, so that one you can even give it a corner, as a small corner like this. Then you tell it here. Now that one imeingia kwa corner sana, utaona. Here, this one is okay here. So you draw that. Then you start by saying, do not invest. That is already a mark by drawing the table, the probability. This one should come up to somewhere here. Then invest. Now, after investing, you put 100 million as cash outflow so that you don't forget. So, put the amount that you're investing, 100 million. Tell me what next? I told you, participate. It will save you. Participate, please. Participate. What is next? Someone tell me what is next? We need to do that one. And then we do another one for 2018.
State of nature, the first year, and then the second.
State of nature. So state of nature, what are you going to have? Yeah. That is the first year. Here is the first year. First year. So what is going to happen here? What are the options?
You have
Are they 2 or 3?
there are only 2.
Someone else now help us. What is the next thing here?
Using probabilities.
Using probability. So we have the probabilities of 0.6
and 0.4.
and
0.6 and 0.4. The amounts
for 0.6 is 80 million.
Thank you. 80 million.
And the other one is board was not clear, but was that 120 million?
Yes.
Yeah. So 120 also.
Then the next thing is now the next. We have not been told to have state of nature. Kama ungeambiwa if the income is like this, the cash flow is like this, then invest more or additional. You now have another alternative node.
Yeah.
But they have not told us there is another alternative node. So just come and put the state of nature again. That is the last one. Then here we have another state of nature. Give me the probabilities. Give me the probabilities. Guys, I'm what is on it too.
.3 and 0.7 hapo chini.
Is it like that?
Yeah.
So what we are saying, and I want to listen carefully, I don't want to get confused. There are two ways of calculating this. You can decide to get the NPV for year 2. How do you get it? You take this times this one times this, plus this times this, then you bring it here, multiply this, you get NPV. That is 0.2 times 0 times 40 plus 0.8 times 55. All this you multiply with the common probability 0.6. Then now get PV for year 2. You are going to get their present value that way. You can get present value. After getting present value, you are doing the same for this one. Here you get the present value for year 2. Utakuwa ushapata present value for year 2 for the 2 items. You come here.
Then that way, I can say something. Then that way is much better than finding for the joint probability. That is confusing. In my opinion, I don't know if the others will accept that.
That is why I'm saying don't get confused. Where angalia alafu sasa utaamua ni gani rahisi kwako. Because mtu ananiambia, oh, this one here jana when we are doing abandonment use this. But now for joint probability unatumia hii. So that is what I'm trying to make so clear. So I'm saying they are just options. You can come here and now do the same like that. After doing the same, multiply with the joint probability which is now 0.4. Now unapata NPV, unapata present value for year 2. Then you get present value for year 1. Present value for year 1 is very easy. Once you have the present value for year 2, so you can add hii na hii chini. This one and the one that you get here. Both of them are for year 2. You'll add all of them. Then you come to year 1. Year 1, you'll have 0.6, this one, times 80 plus 0.4 times 120. Then all of them multiply with they don't have probability, so just multiply with the PV for year 1. Utakuwa ushapata present value for all the items in year 1 plus the one for year 2, you add them. So when you get present value for year 1 plus present value, the sum of these two, present value for year 2, minus now IO, utakuwa umepata NPV. And it is not just NPV, it is expected NPV because you have used the probabilities. Don't just call it NPV, it is expected. That is one option. However, the one that I feel is simple, which you lost.
Don't Rab, we have to write that first before Rabi. I haven't written anything, Malim. I was just listening to you first.
Why are you supposed to write? I was saying don't write.
No, for me, I prefer this one. I think this is simpler than the joint probability. That joint probability is much more confusing to me. So maybe I don't want to know about the joint probability. I adapt this.
So then,
I don't know what Raquel and Collins are saying, but in my opinion, it is that.
Times 35. This one plus this 7. 0.7 times 85. Then all these, you multiply with the joint, their common probability is 0.4. That's the same you did to this. Then everything there, multiply with the for year 2. Year 2, how many percent? 12%. Yes. Also, this one is year 2, 12%. You are going to get present values. These are present values. Now you add the two present values. The total present value for year 2. Then down here. Now this one get 0.6 times 8.0. 80 plus 0.4 times 120. Once you get this, you're going to get present value. You multiply them with the PV, but now for year 1 year, 12%. Then add present value for year 1 plus present value, which was here, total of these two, present value for year 2. You're going to have minus now IO. That is your expected NPV. That is an option that is there. It's an option that is there. But to avoid confusion, because now this one, you have to do this, then you move here. Wengine watasema we, hiyo imekuwa nao. Now, I can run.
Yes, you can.
Now this one, I feel it is easy and direct. Haitasumbua. The rule number 1, draw the decision tree to Shachora. This one is okay. Rule number 2, ascertain NPV, ignoring all probabilities. Ascertain NPV, ignoring all probabilities. So I'll go to root, every root, and get the NPV. So I will come here and say NPV. Ascertain, yes, NPV. So I come here and get these ones. But we may tell our probability. So I'll take the discounting factor here, which is BF. Discounting factor for year 1, 2%. Remember 2%.
0.8929. That was 13. But the one we did it was 13%. Did we do for 12%?
You can do for 12%. Do for 12%, you see.
Yeah, I got 0.8929.
0.8929. This one. So that is 0.8929. 0.8929. That is what we're getting. What about for year 2? Here.
Zero 0.797172.
Yes,
Round it off.
Can you confirm if she is correct? 0.29?
No, 0.7972.
Is she okay? Now, this one you go root by root. This one is root number 1 here. Take the first one, the cash flow, which is now 80 times the discounting factor 8927 or 29 plus this one 40 times 0.7972. What are you getting? All that minus IO. In that line, the investment was 100,000. So have 100,000 here. What do you get? You come to this line, this one. This times this plus this times this. Of course, that one we know. 80 is the same. So 80, here we shall have in this line 80 times 0.8929 plus this one is now 0.55 times 0.7972. What minus 100? What do you get? That is our NPV. And not just NPV, that is expected NPV. Expected NPV. So we are still ignoring the probabilities. We are still ignoring the probabilities. Here we have 0. Now 120. So we have 120 times 0.8929 plus 35 times 0.7972 minus 100. Then here we also have 120 times 0.8929. That one. We're going to have plus 85 times 0.79272 minus 100. So what are the total?
We are digesting first.
Are you digesting or you are calculating?
Digesting.
Very good. Rachel Collins.
For the one of 55 million, I'm getting, I don't know, I'm getting NPV of 15.278.
5 million. Here, second one. Are you talking about the second row? This one.
Yes, I'm talking of that one, yeah.
How much?
Here, na napata 15.278.
Other one?
The first
For
one
the
I'm
next
getting
one,
three.
the one
The first one I'm getting 3.32.
Huh? The fourth one and third?
for the third one, I'm getting 35.05.
The second one I'm getting 15.278.
That's correct. The fourth one?
For the fourth one, I'm getting 74.91.
74.91. Now, those ones are NPVs. Those ones are NPVs. Now, we come here and now use our table. You remember what we drew here? You now come here and say root number 1. These are roots. 1. Then we have NPV. Then you get your joint probability. Then you have now expected NPV. These are not expected NPV because we have not multiplied with the probability. If you multiply the probability in a course as expected. So the first one, group number one, our NPV is 3.32.
A question, sir.
Yes.
For the first option we did, after getting the PV1 minus PV2 plus PV2 minus initial outlay, that will be the answer as expected NPV. Is that right? The first option we did.
So we got PV1. You got
Yeah, the
value for year one plus present value for year two.
yeah, minus initial outlay.
Yes, you should be able to get the answer now.
Okay, okay.
So this is year two. So joint probability, how do you get joint probability for line one? Take this times this for line one. This line one. This 1, 2, 3. Then we have 4. So multiply this. You're getting 0.12. Then for line two, this times this 0.48. Still. But then here we have 15.278. Then we have number three. Number three, we have 35.05. Joint probability here was 4, right? This was 4 here. So it is 0.4 times 3, 0.12. Then the other one was 0.4 times 7, which was 0.28. Add the probabilities, they should add up to 1. So 4 years, root number 4. Root number 4, we are having 74.91. So let's add on this. The first one, what do you get?
I'm getting the second one, 7.3333.
7.333.
The first one is 0.3984.
0.3.
984.
984. The fourth one, third one.
4.206.
The last one.
The last one I'm getting 20.97.
4.97.
20.97.
9748, if you can write that.
Fine. Add all of them.
Thirty-two point nine one two. 22. 32.9122.
32.9122.
Yeah.
So that is the expected LPV. Total expected LPV is that one. The other one, what did you get? What is the other formula?
No, I didn't do.
Oh, you'll try later.
Yeah, I'll try. I have to try that if I'll get the same answer.
Okay, so that is the end. Do you have any question? Or we do one more, then we leave now that topic. I wanted to do for 2018. that was quite complicated. It was somehow complicated, but not bad. Somebody told me yesterday, at least here we are we can try.
Okay.
But a part class in answer. So, which class is it? Is it a part or a main?
Advanced FR.
How many are doing a main here? It is advanced FR. Advanced FR, eh? Aye.
Yeah.
Na tuingie advanced FR. Let's join. Naona link imefika. The teacher is already there. We shall stop there. You guys will try for 2018. That is an assignment.
It is May 2018.
Yes, May 2018. Question number 1.
Okay.
Okay. You do it, then we share in group. We'll only revise it when we have time. So make sure that you try it. It looks like the one that came last sitting, but there's a small difference. Lakini zinafanana kabisa. There's a small difference.
Okay.
So try it. In our next class, we shall now move on to look at inflation and capital budgeting. That is the next subtopic. I think that speed is not bad. Anytime we have an opportunity, we shall be having class. Inflation and capital budgeting, then we go to replacement analysis, then we go to capital rationing, linear programming. So next week, lazima tumalize. There are 4 subtopics, but we have to find a way of finishing next week. Any opportunity available, tutakuwa na class. Mwalimu yafaa, mwalimu asipokuja.
Tomorrow we'll be having another class also. Or you don't know?
Do you have class? Check. Tomorrow we have. Yes.
No, in the timetable we don't have a class tomorrow, but I don't know if you are coming or not.
Timetable iko. Saa 12 check.
The new timetable.
Yes. The final timetable, that is the final.
Yesterday there was a timetable which was sent to us. Was that not a final?
Oh, so it is not there.
Yeah.
So, and the way I wanted to do class, okay, unfortunately it's not there. So Sunday I do my class.
Yeah. In the timetable you have only 2 classes, Wednesday and Saturday only.
Right.
I thought I didn't see that. Okay, then maybe you have a makeup class or that. You can see yourself. I don't know.
You guys can move. Those who are doing where ndio umebaki hapa.